Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's March 25th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. No. The answer to your question is no. You should not rush in to buy stocks here. Not yet. That's the question I'm getting like crazy. Is it time? Should we get back in? I'm going to be honest with you. Most people have been credited for making bold calls, whether it's a top or a bottom. They're usually not right both on the bottom and the top. So I'm putting that in perspective and letting you guys know that up front because we were very, very well ahead of this, in early February, saying that the markets would fall and then just continue to, as the virus spread, saying much more risk ahead. But picking a bottom is not going to be easy. People are looking for the exact date, but be very careful here. Be very careful. Because I have to admit, I love the rally in stocks on Tuesday, right? The market surged 11%, whatever. Throw whatever stat you want. Biggest point increase, I believe, in history. So remember, the top 10 largest gains in the market all came, if you're dating back to the Depression, they all came during bear market times, which kind of makes sense when you think about it. Just putting things in perspective. Now, we saw this surge. Why? Well, Fed came out, massive stimulus plan, which basically included backstopping everything and anything, employees, small businesses, whatever it takes. They actually said that, whatever it takes. Unlimited. Pretty crazy when you think about it. But the biggest catalyst I thought from that initiative was for the government to purchase investment-grade bonds and even bond ETFs, which basically means the government is printing money and investing it in our companies, right? That's what that means. They didn't say that. They avoided saying that. Nobody's looking at it that way, but that's really what it is. Then we had our politicians finally pass a plan. Good for them. Amazing they got together to do this. It's always got to be a pain in the ass for these guys, but it's a $2 trillion plan. Most of this plan, I believe, with that 11% move, is mostly priced into the market. I'm doing this around noon on Wednesday, right? So doing the podcast, doing videos for our newsletters, just so you're more timely, because think about if I tape some of this stuff on Monday or two. I mean, the market moves in 1,000, 2,000 point increments lately on a daily basis. So you're going to get this today, a little bit later, but it's 12 o'clock. The market's been flirting back. It's actually up now 2%, the Dow, but it was up, I think, 3% or 4%. And then came down 1%, and now it's up again. So I think a lot of this is really priced in. But the rally is, I'm talking about the $2 trillion plan, right? Because we knew it was going to happen. It's just a matter of time. So the rally was nice. I mean, we needed it from a sentiment standpoint because people are just looking at their TVs and it's just crashing and crashing and crashing and crashing. We need it from a financial standpoint because there's a ton of investors who did not sell. They were down 35% before this rally. Now the market's down around 25%. So it was needed. With that said, guys, okay, you want to put things in perspective. I'm trying to stay ahead of this. We are well ahead of this, and I'm going to give you my thoughts here. Because when we look at a rally like this, every sentiment indicator, every sentiment indicator, right? These are technical indicators. I told you, forget technical indicators because, most of these showed the most oversold conditions like ever. 100 years, 50 years, 30 years, ever. They showed oversold conditions when it was down 15%, 25%, 25%, right? That's why I said you have to know these things. But we would do for something like this, a massive snapback. I mean, even if you're short, you have to cover your positions, which is buying. In short, would do for a pretty big rally. Now, what I did not like about the rally, the safest sectors, consumer staples, healthcare, they underperformed. While high leverage industries saw individual names increase by 30 to 40%, I guess that makes sense if you think everything's going to be okay. And these are the stocks that were down the most. But you look at cruises, airlines, retailers. I mean, L Brand's up 40% in a day on that Tuesday. Autos, GM popped 25%. Norwegian Cruise Line surged 40%. MGM Casino popped 30%. Remember, every company that I just mentioned that popped are closed and going to be closed for another 4 to 6 weeks. How they're going to pay the employees? I don't know. The government says, don't lay off anybody. Okay. You try running a business and you're generating no revenue for a month and you still have to pay your employees. Let me know how that turns out. Let me know what the government's doing for you, and have they paid you that money already? Absolutely not. They're still going through the paperwork, even though we're closed, we're shut down. So when I see a move like this, it was a risk-on trade. What that means is, a lot of this is computers, algorithms, and just pushing this thing all over the place. But it's kind of saying that everything's going to be fine the second half of the year. And not just the second half of this year, that, hey, we're going to, even Ben Bernanke came on TV today and was like, hey, this isn't the Great Depression. No kidding. We know that. And we're going to be fine. This is going to snap back. Guys, I'm not there. I mean, I'm just not there. So if we put this 11% increase in perspective, and that's what we need to do, it's basically just a rebound of the past 2 trading days where the markets fell 10% on Friday and Monday. So we're looking at those 3 days were a wash. Also, if you look at this rally, despite an 11% massive increase, one of the biggest increases, I think, since the Depression, largest point gain ever, whatever headline floats your boat, feel free to use. That's what they're doing in the media. Despite that rally, this month, March, is still going to be the worst in terms of performance since 1987. Again, that's after this rally. Now, before you go out and buy everything aggressively and think, wow, here's the bottom, these stocks are going to surge higher, here are some things that worry me. And again, this is from someone that's been really ahead of this and trying to stay ahead of this. A lot of things are being reported. We were reporting weeks ago. So one of the things is the stories I'm hearing from everyday folks. Keep emailing, frankcurzioresearch.com. This is so important, guys. Let me know what you're hearing at your businesses. Let me know what you're hearing, in your neighborhoods. Are people out? Are there, what stores are closed? Over here, Starbucks is actually closed. One of the stores that are closed is Starbucks. Most Starbucks, the drive-thrus are open. That was surprising to me. But the stories I'm hearing is, from oil workers. Tons of people writing in saying, they getting laid off. Restaurants. I mean, there's 7 million workers that are about to lose their jobs. I mean, think about if you're a restaurant owner, how much money you have to put up front to just run operations, to get all your food, to make sure it's all fresh all the time. All this stuff. A lot of these companies may have a little leverage, may have some loans, but you shut down revenue and no one's coming in for just a week, which that's how long really the lockdown's been. What, like a week and a half, 2 weeks, really, if you're in New York City? 7 million workers expected to lose their jobs. How's the government going to save them? I don't know. I don't know what the plan is. I had one friend who is retired, and he owns his own security firm. And he said, you know what? The company, they didn't pay him yet. And he said, what's going on? Are you laying us off or whatever? And they said, no, we'll pay you. And yes, this is an industry leader. It's a large company in the space. I'm not talking about, it's not like a Microsoft, but it's just an industry leader in the space. It's a reputable name that every one of you heard of. I just don't want to bring it up. So he owns his own security firm, and they pay him, and he hires employees to do the security. And it's 2 different places. They have one is in New York, and another one is in, I believe, in Los Angeles or California somewhere. So he's told me, he's like, I got to go to the bank, try to take out a loan, or I can't pay my employees because I'm not getting paid by my company. And he said it's up to $100,000 right now that they owe him. So companies just not paying him and didn't really tell him. Again, this is a legit company. This is a small business trying to work around a few things. That's very surprised. But when I look at this and the stories that are coming in right now, I mean, you haven't seen nothing yet. I mean, from the unemployment front, it's going to get a lot worse from the growth front. I mean, we saw shutdowns last for how long in China? Around 10 weeks. They're going to say, well, it was like 4 or 5. It was 10 weeks. It was 10 weeks. From the start, believe me, I covered this from the start when they started saying, okay, we're going to close certain businesses down. And it's about 10 weeks in total before you opened up. And by the way, China, even though it came out and said, our stores are open. It's not the point. I mean, that's a start. But you're seeing a lot of this capacity. I mean, completely shut off. It's still down tremendously. There's not a lot of people shopping right now and going to stores right now. It's going to take a long time. Long time to get back to normal. But what are we, week 2 maybe? I mean, you look at Goldman Sachs expects GDP now. They thought GDP, it was going to be a snapback. I think they had it for second quarter minus 1 or 2% when I started doing my research. When the coronavirus started hitting maybe in the third week of February, -2, then a quick V-shaped recovery bounce. But now Goldman Sachs expects Q2 GDP to fall by 25%. That's unheard of, guys. That's unheard of. Morgan Stanley says it's going to be like 30%. You know what? Fed President Bullard says GDP is going to fall in Q2 by 50%, and unemployment will hit 30%. Ben Bernanke saying, we're not in a depression. You're right. I get it. But these are depressionary numbers. And I have to tell you, if Bullard's right, we are no way factoring GDP is going to 50% decline, unemployment 30%. I love it. Companies say, we're going to pay our employees. We're America. It's the right thing to do. How could that be sustained when you're not generating revenue? I know it's a nice thing to say. It's cool. And I know the government's behind you saying, hey, just don't lay off your employees. We'll protect you. But still, how are you doing that? Looking at Marriott, you're looking at Hilton, you're looking at the airlines, you look at Airbnb, you look at all these travel industries, the airlines, they're running out of money. They're running out of money. How are they going to pay their employees? They can't even tap credit lines. They're almost through them. There's no business. There's nothing coming in. It's shut off. Again, the government says it's going to help. What's the process? Nobody knows it yet. Oh, great. Unlimited, whatever. We're going to be here, whatever it takes. Well, tell me, what does it take? What do we do? How do these companies pay their employees? How are they going to get reimbursed by the government? What's going on? Because companies are running out of money. I have to tell you, most are rushing into cash right now, too. They're not looking to hire anybody. They're not looking to acquire anybody. They're looking to preserve their capital just in case the whole entire world on television is wrong, saying this is going to be a snapback. It's a V shape. Now it's a U shape. What if it's not? You have to ask yourself that question. What if it's not? It's a logical question. So I know you're assuming, well, Frank, the market's still down 25%. Is this factored in? I really don't know. I hope it is. I don't see it. From when I see every CEO going on TV, every major CEO's gone on TV. We're going to get a snapback. This is America. Second half of the year is going to be great. How do you know that? You don't even know what earnings are going to be. You're not even reporting your numbers. You pull guidance. You're not even giving us like maybe this could happen or this is what's going to happen. How much we're going to generate? Nothing. It's crazy. I mean, I love that Nike's up. Say, wow, our China shops are back up. Well, every other one of your shops are closed and no one's really shopping that much in China. And that was your biggest growth engine. People were shopping more than ever at your stores. That was their growth engine. That's turned off. That's going to be negative for a long time. And I know that stock got hammered. But is it all priced in? I don't know. It would be nice to see numbers. But we don't have them. There's still uncertainty. It just scares the hell out of me. A company has no clue what they're going to earn this year. They can't even give us a ballpark figure, but so many people on TV are optimistic, saying that we're cheap right now. Cheap based on what? Show me your research. What are you expecting earnings to be? Because I have to tell you, when I look at the sell side, they're like hiding under their fucking desks right now. And you look at Apple, 27 analysts had buy ratings on it. All of them still have their buy rating on it, even though the stock crashed. You're looking at earnings estimates. They barely lowered their earning estimates for 2021. Expecting a full recovery, everything back to normal. Everyone's going to jump on planes again. I mean, come on. There's a lot of risk out there. But these guys have just their models and what they're updating for. It's just... you're left scrambling when your job is to model, which means I'm looking at numbers that the company is forecasting and giving me and coming up with a price target and a rating. It's hard to do your job when companies are like, we don't have any idea what we're doing this year. We don't even know when we're going to open. But yet these guys, how don't you downgrade the stock to neutral and say, wait on the sidelines? You still have buy ratings on these companies? Are you crazy? Hey, this is what you earn those massive, massive fees for? To not update your people and say, hey, things are going to be okay or not going to be good or what. They're not even updating. I know. I have access to all this stuff. They're reporting. They're trying to get ahead of it. They're still so far behind. I mean, I bet you if you took a look, usually I think, don't quote me on this, but I think it's about 15%. They mandated this, that 15% of the stocks covered in your universe need to have sell ratings or something like that. That's why you see when a company, even if Goldman or Morgan Stanley covers an entire industry, they can't have a buy rating on every single stock in the industry. They have to put a couple sells in there. But even with this massive fallout, I'm curious to see how many downgrades and how many companies are sells or even neutrals. I bet you it's hardly changed. If I had to say 80% of the companies had buy ratings, maybe 70% of the companies had buy ratings, I bet you it's 65% now through this whole downturn. I mean, they're hoping, they're praying. I know people, I have friends in these industries who manage these funds and brokerage accounts and things like that, and they're just telling their clients, hold on, we'll be okay. Hold on. That scares me. They're not even that nervous. They'll come back. Remember the credit crisis. Don't worry. Another thing that scares me, we're definitely not factoring the possibility of a secondary outbreak. Wuhan no longer on lockdown, where the virus originated. Don't call it the Chinese Wuhan virus. That's just, I don't know why. Whatever. Things to talk about that are fun, that annoy people, which doesn't matter. It was originated in China. China did not, we closed our borders in January, in late January, and China got really pissed off at us and said, why are you doing that for? Even though they knew they had an outbreak. So they basically wanted it to spread everywhere, right? That's what China wanted to do, right? They silenced everybody. They're whistleblowers. Unbelievable. That's where I am. That's a whole other problem when this thing ends, guys. A whole other problem. And I'm going to go over another major problem that nobody's talking about. But the secondary outbreak, everyone going back to work at Wuhan. Not everybody, but it's opened up now. No more lockdown. What happens if somebody gets infected and all of a sudden they infect 20, 40, 60 people? We'll never know because China will never tell us that. But when we start opening up, all right, what's going to happen? You got to run to the Disney parks, the cruises, book vacations. Hey, if the NBA gets the approval to, hey, these guys got to go back to work and maybe we see the playoffs for NBA, what happens if one player gets tested positive for the coronavirus after the lockout? We have several players that tested positive. Not even giving out the names of the NBA players anymore. But how's that going to impact? You going to shut down the league again? I mean, we've seen players like Michael Jordan play with the flu and winning championship games, the playoffs, a great game. We've seen that before, but now you got to shut down the whole league and quarantine everybody again? Is that what's going? I don't know. You tell me what's going to happen. Are you going to go to see an NBA game where maybe a fan's infected and it gets out that that's where it's originated from? I mean, you're already sitting on top of everybody. It's not like you could avoid anybody. The person in the seat next to you, I mean, unless you know them or not, but you're on top of each other at a game. I mean, people sharing the same cup holder sometimes. You might drink someone else's soda by accident. Whatever. I mean, are you going to go there? I don't know. But a secondary outbreak, I mean, that is nowhere near priced in. Again, these are things I'm hoping don't happen, but they can. And this isn't looking at the probability, looking at odds, saying, no way, this isn't going to happen. I mean, I'm not throwing things at you that are like, the market's going to remain terrible for 2 years and all this stuff's going to come in. The whole world's going to get infected. And I'm not throwing crazy things at you. This is like logic. This is common sense. Don't you think if everybody goes back to Wuhan, there's going to be one person that has it and it's going to infect other people? I mean, isn't that possible? How do you handle that situation? You're going to go on lockdown again? Another thing that worries me, that probably the biggest risk right now, the biggest guys, is Europe. I mean, China was already dead. China was horrible before the coronavirus. I mean, with the trade, people were moving their supply chains out of China, companies. Then you have protests in Hong Kong, and now this. I mean, you have no choice but to lie to say things are good. Who knows what's going on there? But the whole world is watching. We're trying to follow a model of a country that lied to us and spread this everywhere on purpose, right? They could have stopped it. They had everything there to stop it, but they didn't. And they got pissed when everybody closed their borders. You do the math on that. Europe? Man, Europe is in big trouble. Big trouble. Nobody's talking about Europe right now. And I'm going to give a shout out to the Fed here. I know you guys are going to turn this off right now. but you got to hear me out. I know it's normal to criticize the Fed. Everybody hates the Fed. They're the worst. Every chairman gets abused. I get it. I get it. I understand. Yeah, that's the business we're in. But I'm a fair guy, and I have to give the Fed credit here. Basically mandated that our banks have enough capital on hand to withstand a negative 5% decline in GDP, a 30% market crash, and a 10% unemployment rate. If you listen to this podcast over the past 4 years, I've been saying, okay, we got to ease this up a little bit because these conditions never happened, not even during the Great Depression all at the same time. This way it frees up. And I said that because I don't want to give away my financials, but I bought a house for my mom. And I had easily enough money to cover it several times over in cash. And when I tried to get a loan, they said, no, you can't. Just second home, you can't. I was like, what are you talking about? And just because restrictions, just because in the computer it says no, that's it. They don't ask any questions. They don't want to see my cash balance. And so I had to pay for it in cash. I said, this is a joke. Now it doesn't seem like a joke because our banks fully capitalized and they can withstand a lot of this right now. Remember where we came from, guys. We came from a super strong market where our banks had the best balance sheets ever. You're seeing record profits. Again, they're going to get hit. They're going to get nailed. But we came from a super strong base. Europe didn't. I mean, even after the credit crisis, they didn't recapitalize their banks. I mean, you want to look at Europe and the top 5 economies. The top 5 economies are Germany, UK, France, Italy, Spain. They account for 70% of the EU in terms of GDP. Germany being the highest, 21%, UK 15%, France and Italy around 12%, Spain 10%, a little bit lower than that. But I went back and looked at the past 2 quarters of GDP pre-coronavirus, which is the last 2 quarters. Germany grew 0.2%, and the most recent quarter, they didn't grow at all, 0. UK, 0.5%. And then the past quarter before coronavirus, 0%. France, 0.3% growth. Last quarter, negative 0.1%. Italy, 0.1%. And the recent quarter, negative 0.3%. In fact, if you go to Italy, you look at the past 8 quarters, Italy hasn't grown at all. This is pre-coronavirus. This is before you shut down Europe. And your banks are not fully capitalized. Nobody's really talking about this. In the UK, Brexit, they're out. How aren't you? I mean, this is going to create so much turmoil. What I'm thinking right now is way, way too far ahead. And I was talking to this with a good contact where what happened after the Great Depression? What did it lead to? World War II. With Italy and Germany. I mean, you're looking at a scenario that's eerily similar. Again, I'm way too far ahead right now, but that's the way I'm thinking. But how terrible is Europe right now? How terrible is the rest of the world? They don't have what we have here. And we were by far, especially the developed nations, just the strongest in terms of GDP growth, unemployment low. We're coming from a very high base and we're struggling to deal with this. How are these countries going to? And India's another one, just shut down, lockdown, 1.3 billion people. But everything's okay. Go out, buy stocks, we're fine. And maybe it is priced in when we're down 25%, maybe. I said even down 30%. Based on valuations, we're probably close, but sentiment-wise, we can go a lot lower. Let's see what happens. Because I can tell you, the Fed is not done. The Fed is definitely not done because every day that goes by, it's another market, especially within the credit markets, that become frozen and they're getting a call at things they have to do. So the president's going to be on TV a lot, probably almost every day, and I bet at least every week is going to come out with another stimulus plan to block this, to back this. I'm going to get to that later on. Guys, you're going to blow you away later on in statistics. And it's not going to be crazy, but there's one market that's crazy that the government is not even talking about right now. That's starting to freeze. But when you look at Europe, what does it mean that Europe's going to shut down? I mean, there's basically in a recession pre-coronavirus, now you shut down the whole economy. And we're going to see a flight to quality where governments are going to be buying U.S. dollars like crazy, right? Flight to safety. They're going to push the dollar higher. And people are saying go into gold, and gold has had a nice rally recently, but gold usually doesn't do well when the dollar is strong. So there's a fight right now between gold bulls and bears. I'm not sure what side I'm on yet. Tried to pick away at a couple from my Curzio venture opportunities, but stopped out right away. I think but now a lot of these gold stocks have, after falling 30, 40% during the last 4 weeks, bounced back. Gold pushed higher after the Fed announced we're going to spend whatever it takes. But I like to see the couple get away from the dollar here when it comes to gold. But I don't know what side I think there's gold companies you could pick away at, but something that's interesting, right? What's Europe going to do? So again, companies have no idea what earnings are going to be this year and even next year. I'm just surprised to see every CEO on TV believes that everything's going to be fine in 2021. I mean, to me, I think that's absolutely crazy. You don't know that. To assume everything's going to go back to normal. That's telling everybody, you should buy stocks right now, no matter what. Be careful. These companies aren't generating revenue. They're going to be locked down for at least another 3 weeks. Wait till you see the news coming out of New York. The hospitals have no more supplies. And someone sent me an amazing stat that it was over 80% of the people who died from the coronavirus in Italy died in their homes. I think that was in a Lombardi region, but I was blown away by that. Why? Because they said, they didn't die in a hospital or an ICU. They sent them home. We can't take you. And they wound up dying. Could that happen here? Because I could tell you the people who do contract this virus, especially over 60, and if they go into ICU, there's a much better chance than if you're telling them to go home. But if there's no hospital beds, what are you going to do? But just this assumption that everything's going to go back to normal, guys. I mean, do you think everyone's going to run the Disney parks? They're going to go back on cruises right away? Are you? Put yourself in this position. Forget about what the economists say. Forget about what the so-called experts say. Forget about them charging fees like crazy. And again, these people, some of the people that I'm seeing, it just should not be giving anyone advice. And it's sad. But are you going to book vacations? You're going to take an airplane right away? You think they're going to spend money immediately after their portfolio just declined 35, 40%? And yeah, it's bouncing back a little bit. I mean, I mentioned the NBA. I mentioned, if a lot of these things, Major League Baseball comes out, I mean, are people just going to rush to stadiums and start watching these games? What happens if someone gets tested for the coronavirus maybe 3 weeks from now, 4 weeks from now? We assume that no one has it anymore. It's all gone. But stay patient here. Again, I know we're down 25% in a month, still down 25%, but lots of uncertainty, lots and lots of uncertainty. And you can't just say, okay, I'm going to buy this. I mean, look, I picked away at Boeing. I'm probably up a little bit in the position, but I got smoked on Boeing. I bought my first one at 160, then I bought it at 120. I think it went down to 90. Now it's a lot higher, whatever, 130, 140, 150, wherever it is. But this is something I look at 3 years from now that makes sense, but you have to be willing to take a beating because this market's going to be like this. It's going to be like this for at least another 30 to 45 days at least. And if any of the risks I just mentioned come to fruition, which I hope they don't, other than Europe you're not going to avoid that. Europe is in a ton of trouble, load of trouble, guys. I mean, with a lot of this stuff, any of these risks, I mean, we're looking at another 3-4 months, and that is not factored into stocks right now. So just be patient a little bit. Now, you saw, some of these stocks go up 30, 40%. They still have their operations closed. And how can you buy a cruise right now when not only is it closed, when are they going to open up? Probably later than anybody. And when they do, who's going to go on a cruise? Yeah, maybe the government backstops them, backstops their debt, and, tries to pay their employees. It's not going to result in more people going on cruises right away. It's just not. And if you want a little more uncertainty, what the hell is the plan in the U.S. right now? What's the plan? Are we on lockdown? Are we not? If you live in California, if you live in New York, you'd say yes. In Florida, we're definitely not. Most states, probably just like Florida, they're not. Again, it makes sense for heavily populated areas to be on lockdown. Now the president comes out and says, hey, you know what? I'm thinking of letting young people go back to work. Hopefully by Easter. I mean, now you're doing this after you initiated a kind of lockdown? That's confusing the people. And look, I get the move. I mean, of course, it's an election year, and you can't keep the economy closed. But I understand this move to do this. I get it, because before the 11% rise in the market, and yes, we're doing pretty well today, We were down almost every single day in the last month. I mean, it was crazy. And at one point, you have to ask yourself, is sacrificing the economy worth all of this? And that is a tough question. Do you make it like, hey, this is the flu, let people get it, and yes, we know that older people could pass away. A politician could never ever say that. Or is it worth does the cure hurt much worse than the disease? Well, you shut down the economy, it could result in more deaths. It could result, I mean, just the negative effects could be 25x compared to treating this like the flu. I'm not saying we should do it. I'm saying I understand the argument, and that's the argument right there. Now, what happens if this continues to last? Should we push people back to work? Because I could tell you, there's a lot of things not factored in. I mean, guys, go on Curzio Research YouTube. I just did an amazing interview, and it's a video interview on Skype with Ed Carr. So Ed Carr is the CEO of U.S. Gold, which went up 100% yesterday on really good news, but that's not why I interviewed him. Again, that was down a lot, but now it bounced back. A lot of gold stocks are bouncing back. But he is in Florence, and he's on lockdown. He's telling me things are different now. Lines are much longer. Most store shelves, we see it where they're kind of empty. But if we go on a different day and go early, we can get. He said, no, it's not like that. And people are losing patience. There was an old lady that cut a line, and they were screaming on her and yelling at her. He said, patients are running thin. That patience is just they don't. I mean, you're in your house, you're with your kids all day. I mean, you're locked up. It's pretty crazy. I mean, you do it for a week, all right, 2 weeks. You're doing it for a month or 6 weeks, 10 weeks. Wow. Again, things that are not factored in. But I was telling you about that decision and how do we talk about it? Because it could result in more deaths where, do we continue to lock down, or do we say, hey, let the young people go back to work? Again, I'm not advocating for this. I'm saying I see it, but this is a topic I'm going to discuss with my guest. First-time guest on Wall Street Unplugged. It's a name that I'm sure almost every one of you heard of, since he has the best nickname in the world, which is Mooch. Anthony Scaramucci is here. You're not familiar with Anthony? He's a founder and managing partner of SkyBridge Capital. Been in pretty much the hedge fund industry, the investment industry, worked for Goldman Sachs for 8 years, but you might know him as the former White House communications chief for Donald Trump, which he was only there for, I think, a week or 2 weeks, and he and Trump had plenty of back and forths over the past 2 years. This interview is not about that. I know it's the entertaining part. It's about coming up with a plan for the coronavirus risk in terms of how much stimulus we need. Are we going to need more fiscal, monetary, health? How we can do to protect ourselves right now that maybe you're not really hearing in the news? And Mooch is very, very connected in the hedge fund community. Again, he worked for Goldman Sachs for 8 years, he has his own firm. Also very connected on a political front. So he's going to share some of the things he's hearing out there, the negatives and the positives. It's going to be a great, great interview. It's coming up in a minute. In my education segment, I'm going to share my game plan with you. I told you I'm working harder now than I ever worked in my entire career. And even if you're in cash, you should be doing the same exact thing. Trying to find new ideas. Who has exposure? Who doesn't? Diamonds in the rough. What's going to come back? Early stage cyclical companies, that bounce back tremendously. Small caps. You should have these on your radar. Companies that are likely to suspend their dividends. Like the Chevron CEO goes on TV and says, the most important thing for our company is to maintain the dividend. Why the hell is that the most important thing for your company? Who cares? The most important thing is to preserve capital. I mean, if your dividend is like 7-8%, cut it to 4%. It's still going to be one of the highest in the entire freaking industry and in the S&P 500. Then you could use that money to buy all these freaking companies who are cash strapped right now that you could buy for 5 cents, pennies on the dollar. That makes more sense to me. But for you to go on TV and say, that is the biggest thing, our dividend is safe, and I heard it from Kinder Morgan. Same thing, said the same exact thing. This is 3-4 years ago when oil price in 2015. We're fine with, I did the math. There's no way they could sustain a dividend. Then they finally cut it. And the company went all the way down and came all the way back. But that's your biggest concern as a CEO, with maintaining our dividend. You don't even know what's coming up. If oil prices stay below $30 a barrel for 6 months, how are you going to maintain that dividend when you're not making money? How are you going to pay your employees? All right, well, we're going to cut our workforce by 35%, but we're committed to maintaining the dividend. I'm like, this guy's on another freaking planet. Anyway, prepare. Look at different companies. There's a lot out there. I'm going to show you what I'm buying, what I'm looking to sell. Also, what I'm hearing out there from my best sources, which includes a large independent bond fund manager who's pretty nervous right now. At least that's how he made me feel after the points he brought up. And one of them is a massive market that's starting to freeze that very few people are talking about. It's going to be a must-listen to education segment on what to do now with your money. And before we get to that, here's my interview with Anthony Scaramucci, otherwise known as the Mooch. Anthony Scaramucci, thanks so much for coming on Wall Street Unplugged.
Hey, I'm doing great, Frank. But if you hear kids screaming in the background, that's real live reality radio podcasting, okay? I am in a bunker in my house.
It's the new norm, right? I had 2 interviews, same thing. Kids running in, going crazy. It's kind of crazy,
Screaming, yelling, everyone's mad at each other. I think my wife's filed for divorce 4 times since I've been home, but that's fine. I haven't even been home a full mooch. You know what a full mooch is, Frank? It's 11 days. It's an 11-day period of time, okay? That was my time in the White House. So I think I'm in 11. I think I'm 4 days away from a full mooch, and the place is going crazy, and I'm probably losing a little bit of my hair.
What happens if this goes another 2 months?
Yeah, so I think the likelihood of it going another 2 months is low. Just what I know about the president and what I know about the American economy, and I know the epidemiologists would like it to go longer. But I sort of think this is a 3 or 4 week exercise for the American people. I don't see it going the 3 months. Certainly 3 months would flatten the curve. We're not set up to do that as a group of people. You know, it's not communist China, unfortunately. Well, fortunately, but you know what I mean. For the purposes of this, they're not going to set up the quarantine the way they did.
No, it makes sense. Now, most people know you as the founder and managing partner of SkyBridge Capital. You mentioned already, former White House communication chief, but you worked at Goldman Sachs around 7-8 years, investment banking, been around this world most of your career, private wealth management. So you're familiar with the numbers, you're familiar with the data, especially in terms of the stimulus that's being thrown out right now for the coronavirus. I heard you throw out a number there. We heard Ray Dalio, $4 trillion. We're seeing maybe $1.8 trillion about to get passed as we're doing this interview on Monday afternoon. But you said 3.2 trillion. Could you tell me how you come up with that number? Because, again, there's numbers all over the place. I'm just curious. Yeah.
No, but I'll give you the math. I want you to know we did a lot of homework on this. Of course, I supplied all this math to the guys inside the administration and Treasury. The first thing I did, and first of all, Ray Dalio may be correct. By the way, more is always better in a situation like this. You know, in a crisis, there's a couple of different decision-making modules. One should never underreact. And one is always trying to gauge if they're overreacting. But in a financial crisis that's concomitant to a healthcare scare, a little bit of overreaction wouldn't hurt anybody. So I wouldn't mind $4 trillion. But I'm saying 3.2 trillion. I did the adjusted gross income numbers for all 50 states. I backed out each person's savings rate. I then backed out the per unit consumption, but also recognizing that their consumption is going to be down about 40 or 50%, meaning they're not on an airplane, they're not in the local restaurant, they may be ordering takeout, but they're not going to the legion of stores in their local Main Street or up and down Fifth Avenue or somewhere in the Miracle Mile in Chicago, something like that. A result of which they need money for their utilities, they need money to pay their water bill, they need money for food for their families, and obviously their cable bill, et cetera. When you do that math and you reconstruct that consumption for the nation's consumers and the people that need it most, it's about $800 billion. So that would be $3,000 per adult, $1,500 per child. That would get you through the crisis. That's sort of the helicopter money part of this, where you're helicoptering money into areas that need it the most. Second piece of this thing is a tax furlough. And I would be calling on the president to create tax amnesty for anybody that's making less than $100,000 a year. So you don't have to pay income taxes in 2020, that calendar year. That's $250 billion. And just stay with me. I'm almost done. $2 trillion in an accordion-like structure. So you may not get to $2 trillion, but you have it there to help all businesses. Okay, and I'm calling it a giving, granting, or lending program. And so you're giving it to small businesses, you're granting it to universities that may need it, and you're lending it to the country's largest corporations. So you have a plan for the barbershop and Boeing in the $2 trillion, and you can set up an agency that could help facilitate that and sort of deliver that into the marketplace immediately. My last piece, and this is where you get to the 3-2, is $150 billion to the nation's hospitals. We are woefully underbedded in the United States. We obviously don't have enough ventilators, and you would need literally a Marshall Plan for our healthcare systems. The plan that's on the table right now, as we're speaking, is $75 billion. It's just not enough. And I just want to draw context for you. 331 million people in the United States. We have 1 million hospital beds, 300,000 of which are ICU units. If we don't bend the curve, and even if we just do partial mitigation, the math looks like there'll be 3.5 to 4 million people that will need a hospital, and many of those obviously will need ICU, and a lesser portion, but many will also need ventilators. So we're in a healthcare crisis, and I'm going to propose that the U.S. government creates a cabinet-level position to deal with pandemics, almost like a Secretary of War for viral pandemics going forward, very similar to what we did in 9/11 with Homeland Security.
No,
How's that for off the top of my head, Frank? Is that
love
okay?
it. Love the numbers. Love the details. So here's my next question, which is interesting. So you saw David Tepper get on TV. Big deal because David Tepper was one of the ones that told us in 2011, should buy everything. Government's backstopping everything if it's going to go higher. So everyone wanted to hear his opinion. He obviously said we need to get out of this lockdown. We had the president tweet that he's talking about this with his contacts and staffs, where lockdown may be worse than actually just having young people go back to work. Like blank fines saying, those at low risk should return back to work. I think there's right now in the middle of this, that there's an argument being like, okay, things are going to get so bad in the economic side where we're seeing Goldman Sachs 25% decline in GDP to second quarter, Morgan Stanley 30%, Fed Bullet even said 50%. Are you seeing this? Because you have great context in the industry, both in politics and in hedge fund world. Are you hearing this as well, where people are like, wait a minute, okay, this lockdown can't last. So if we don't even see it subside in terms of that curve, do you think that that's an option where we might just say, okay, let's go back to work and just have the older people stay home?
So listen, it's a very complicated question. It's a great question and a very complicated question. You often give a very complicated answer. So I don't want to oversimplify things, but here's what I would say to you. After analyzing the situation, knowing the culture of the United States, and knowing the political situation, that this is an election year, what I would be calling for right now is a $3.2 trillion stimulus. I would shut the United States stock market and the banks down for 5 days. And I would say that would happen, in the next 2 trading days. So if you need to get money out of your bank, you can go to the bank now. The Fed will have the window open to let you get as much money as you need. But everybody take a chill. We're going to shut the banks and the U.S. and stock and bond markets down for 5 days like FDR did during the Great Depression. Only thing we have to fear is fear itself. Number 2, I would be imposing a 21-day national quarantine-like, shelter-at-home-like order that you're finding in New York State, in California. And I would ask every American to make that sacrifice, to pretend that we're back in 1942, and rather than getting drafted and fighting off the shore of the United States at war, the way we need to fight this war is some level of aggressive social distancing and social containment. At the end of that 21-day period, I would tell the people of the United States, based on the epidemiology, we may go for 2 more weeks, and we may not. And I'll let you know as we get close to the end of the 21 days. But have it in your head that we'll be locked down for 21 days. And so some of the fear in the marketplace, Frank, is that people think it could be 3 months, it could be 6 months. There's a lot of nonsense in social media and a lot of conspiracy theory and apocalyptic garbage, the government would be way better served talking the way Andrew Cuomo's talking. Very clear, very open. I think the more information that's accurate and people can trust, the better off everybody will be. Should we go longer than that? If I was an epidemiologist and we were living inside a bubble, yes, possibly. But I would recommend that we not do that, because you don't want what Lloyd Blankfein is saying or what others are saying, that the cure is actually worse than the disease itself for the entire nation. So it's a very difficult decision because people's lives are at stake. So I don't want to make light of that morally, but I think that's where we need to go, and hopefully people inside the administration will start thinking more like that. But this sort of half-measured, half lockdown, half not lockdown, I think is furthering the contagion.
Yeah, and I appreciate your answer to that, because there's no right answer to that, and that is an extremely tough question. It's just that's what we're seeing on both sides right now, and I hate to be the one to make that decision because we are dealing with lives. One of the things that you said, and I've been in this industry for 25 years, lived in New York most of my life before I moved my family out to Florida, worked on Wall Street, lived in Queens. So it's not my best interest to say this, but I've been arguing that we should shut down the stock market and the bond market and the commodity markets in terms of, you said 5 days. As long as it's very difficult to shut down the economy without the markets. And when I look at the positives, there's very few positives. We're not going to get a vaccine. We've already seen tons of stimulus. There's probably going to be a lot more. But on the negative side, if you bring up any news site, I don't care how far left or how far right, whatever you watch, it's all negative. We're going to see bailout after bailout for a lot of these companies, the airlines, travel industries. You know all this as well. Do you think it should be longer than 5 days? Do you think this is really crazy? Because you're the only person I heard say this, and I want to make people clear that this is not my best interest. I mean, we have a financial publishing firm, but this isn't about me. This is about everyone. And I just see the retirees, looking at that portfolio is down 25% already. How much more could they take? They don't have any working power. The negative news flow, to me, just makes sense to maybe shut down the market.
Well, listen, I think if you shut the market down for longer than a week, I think that would be a real cataclysm. And I'm not recommending that we do it longer than a week, because it's an international market, it's a global market, it's the most secure and diverse market in the world, and you have to remember you want people to have confidence in that market. So I would also tell people that are retired right now who are watching a down, 33% from the record highs of the S&P 500, take a breath. You're back to where you were in December of 2016, which wasn't that bad of a place given where we were in 2009. And this will pass. And when it does, the world's going to be awash in liquidity. There's going to be very industrious people in the economy working, and there's going to be a lot of spring loading and pent-up demand. And so I wouldn't mark the market to where you are right at this second. I would just take a breath, and even if you're an older person listening to this podcast, try to see through this thing for 1, 2, or 3 years. I think the market is woefully oversold here and will come back in a vengeance, but it's going to need a little bit of time.
Now, if you talk to, and that's great. I love people that have different opinions than me. I wanted to throw it out there, so I appreciate you answering that question. But so the people that you talk to and the analysts, as well as I do, when it comes to sell side, it's all about looking at historical, try to draw conclusions and create this kind of cash flow models for the future. Okay, but this has never happened in the history of mankind, where we had countries on complete lockdown because of a virus. Have you talked to, because we have a supply problem. We had it even in China. Some of it's back online. Even supply here is down. We know with the lockdown in the U.S. and most countries, demand problem as well. And just like you did, we can model for this and say, okay, if the market's closed 1 month, 3 months, 6 months, this is how much it's going to cost. This is trillions of dollars. But you can't model for sentiment, which we just talked to. Is anybody concerned about that in your circles? Because I know they go very, very high, much higher than mine, especially in politics. Where are they afraid that these people, where it's easy for you and I to say, well, I'm 47, but someone who's 65, 70 years old who just lost 30% of their savings, and Yeah, they have 30 years to spend that. Now it's down to 20 years, 15. They can't really stand the working power, so they can't see it go down a lot more than that. Is anybody worried about the sentiment side where people just going to be like, I have to be in cash. Otherwise, if this goes down
Well,
another 30, 40%, I could be in trouble.
yeah, well, okay, so then I would say to those people that I would say to those people, take a breath and have the right asset allocation. So somebody in the 60s should probably only have 30-35% allocation to stocks. If they have 100% allocation of stocks and they just saw 30% of their life savings get hit here, I would say that that was probably not the best asset allocation for them, unfortunately. But if you had 30% in stocks, 70% in cash and bonds at age 70, I would actually argue in a situation like that to move some of the money from the bond side into the stock market. I think that would be a better bet for you right now, given everything that I know that's going on in the marketplace. So, but if you're saying person has 100% in stocks and they're age 70, well, then I would certainly tell you, yes, we have to get that person in a better position.
So you talked about Cuomo earlier, and I'm living in Florida now with my family, and just watching him. I don't care what side you are, Republican, Democrat. He gets it. When I see him, he understands it. He's telling how it is.
Mhm.
Is there anything that you think? I know the history with the president and stuff like that, and I don't want to even go there. But is there anything the president should be doing now that he's not doing on the federal level? And what's it going to take for Democrats, Republicans, Trump supporters, non-Trump supporters to come together? We know it's an election year, we get it, but just right now, it's a circumstance that's really impacted people, and people are actually dying. Do you see that where people coming together in your circles, or it's kind of like people still worried about the election year? And what else could the president actually be doing now to help everyone?
Well, listen. I have been very critical of the president. Starting last August, I said there's something wrong here. He's either not thinking properly. I mean, for him to be attacking me and then viciously attacking my suburban housewife was a sign to me that there was something either chemically wrong with him, or he's just not operating with full faculties. He goes through the impeachment process. There was an illegality, and then the crisis. When we get up to the crisis, he's not paying attention to his advisors, the intelligence agencies. Yet, he's got his friends in the Senate are paying attention. They're selling all their stocks in advance of the pandemic. So to me, I was very critical. He said, and let's just go over this. I think it's important for people because they may be watching Fox News and maybe not getting all the facts. He said that it was a no big deal. It was one person. He had it under control. He said there was 15 people going to zero. He said that it would disappear by April. But the epidemiologists and all the people working on it said, no, that's not the case. This is a global health crisis. And then last week, he did a 180 and started to take measures that I think were appropriate to be taken from the federal government. So I don't want to be on this call criticizing him now. I do believe that we are at war. We're at war with an invisible enemy. It's a global war, and it's on our shores, and it's going to wreak havoc on the American people and our healthcare system. And so we need the American president to do well, and I'm rooting for him, and I want him to do well. But I think he would be better served taking a back seat here. And as I said, if he worked with the Congress to get a stimulus through, the second vote just failed on the advanced stimulus. And so they would be better putting down their swords and figuring out a way to get that stimulus through to help the average American. And if he did those two other measures, a 21-day national quarantine and a 5-day market pause, I think that people would calm down. I think there would be less panic selling. I think there would be less panic in the overall marketplace. And that would be more in line with the way Andrew Cuomo, frankly, is operating. So again, not to be overly critical of President Trump, but when he's doing these press conferences and he is saying something that's not scientifically true, and then we have to get people up there from the NIH like Dr. Fauci or people from the coronavirus task force to correct the medical information that the president is sending out, it's not helpful. It's not helpful to the markets. It's not helpful to the average American. And forget about what my feelings are about the president or any level of partisanship. I'm running $10 billion of capital. I don't run it with any level of partisanship. I run it with a very clear-eyed analysis of what's going on. And I think he's hurting. I think he took $2 trillion out of the stock market with some of the nonsensical press conferences.
Now let's switch tunes here really quick. I want you to give us a perspective of what you see in New York. I don't know if you're in Long Island. Again, I've lived in New York most of my life because New York right now is ground zero. More than half the cases are there. We have a lot of New York listeners that download this podcast, but just it also goes global and every place else. So could you give us a perspective of what's actually going on there? Are you allowed to obviously go out to stores? Are you seeing a lot of people on the streets? Are they following those rules 6 feet apart and stuff? Because really, like you said earlier, you're in the house with your family. Same with me here. It's not as bad as Florida as the lockdown is in New York. But explain to us what's going on a little bit to give her a perspective if you can.
Well, listen, I mean, the social deal, it's America. This is a very free nation. I mean, they had Predator drones and they had police and military force in China quarantining everybody. Certainly, if we did something like that, I think it would be too distressing to the American population. I think that unfortunately, we're going to have to accept some deaths. And I would go back to the Mask of the Red Death, which is a very famous short story by Edgar Allan Poe. It was published in 1842, and it was about the death of Prospero, where there was a plague going on, but there was a very wealthy group of people that were hosting a masquerade party. And so somebody who had the plague dressed up like one of the wealthy people and went into the masquerade party and literally infected everybody in the masquerade party, then took the mask off and gave a soliloquy about you're not thinking clearly, you're not caring for your neighbors, and a result of which, by not caring for your neighbors, you're actually hurting yourselves. And so we're at a crisis point in America. The policies since 2008 have created a very big wealth divide. You now have this crisis, which is a pandemic. If we don't figure out a way to put money in the hands of people on Main Street and make the bailout more related to Main Street, it's not going to work. And when you're looking at the country just empirically, we're just not doing enough social distancing, and we're not going to do enough social distancing. So unfortunately, we're going to, like in the death of Prospero or the Mask of the Red Death, we're going to have a level of death related to this disease that'll likely be 3 or 4 times the seasonal flu, if not more. And I think that's a difficult place, and I think it's going to shock people.
Yeah, definitely is a shock. And I guess just one more question here, because I know you said earlier that you manage $10 billion. Are you, if you could say this, if you can't, I understand I'm in the business, but are you starting to pick away here, or have you been invested and just worried?
No. Listen, the opportunity is in the bond market. The stock market is still priced for a recession, but not for a steep recession. Not to scare your listeners, but a steep recession, the peak of the market was 30,000. The market would have to go down to 15,000. And it's 18,000 now, so we're 10-15% away from a bottom. If you're looking at where the bonds are priced for a financial apocalypse. So I think neither of those are going to happen, and I think you have to be patient. I'm in the business 31 years. It's a little bit like the military. When shots are fired, if you're not trained, you run away from the shots. But if you are trained and you went to Parris Island with the Marines, when you hear the shots, you run towards them. So in a situation like this, we have to run towards them.
Okay, and we'll end with this note. So we spoke about, probably a big recession, massive stimulus on the way, lockdowns, potential bankruptcies. All right, so, a lot of negatives there. What's the light at the end of the tunnel? Because, I'm trying to do this with my interviews where it's just not 100% negative. We want to be fair but what is the light at the end of the tunnel that you see?
Well, I hope to God I haven't been 100% negative. If anything, I've been trying to be very, very fair and very, very balanced. I would say to you that the light at the end of the tunnel is a restoration of the economy combined with that stimulus and combined with a Marshall Plan for our nation's hospitals. I think a year from now we'll be on much stronger footing. We're not going to go back to the robust growth that we were experiencing before this debacle because people are going to hedge a little as it relates to their consumption. They're going to be worried about another pandemic, and they're going to want to keep some powder dry. but I do think that we will be in a position that will work. That will work for everybody. And I think if you're 2 or 3 years out from now, anybody that's selling right now would regret it, and people that have powder dry that are buying will be very happy about it.
All right, so we'll leave it there. I just want to say thanks so much for doing it. I know how busy you are. You're getting calls every place to go on different shows and things like that. So
I appreciate being on. Let's stay close.
You got it.
Stay optimistic.
Safe.
Okay, God
will
bless.
Do. Take care, buddy. Great stuff from the Mooch. Actually, I enjoyed that interview. I was hoping it wasn't going to be, a Trump bash fest because, at this time we need to put politics aside. I think the governor of California, I think the governor of New York are doing fantastic jobs. They really are. We need to come together during this time. We understand it's an election year. I get it. Let's try to figure this out first. And believe me, you're going to point millions of figures. If you hate Trump, you can point millions of figures at him afterwards. Again, this is something that's new. Everyone's going to make mistakes. On both sides, you're going to have plenty of points to argue what they did right, what they didn't do wrong. But just right now, when people are dying, when hospital bed, you don't have enough beds for people, let's get together. Please, let's get together just for now, okay? Because I know most people really, really care about other people, which is important. So I love where that interview went. I love that, he put numbers behind everything. He's someone that's very connected in so many different industries, especially politically of what's going on, hedge fund industry, what's going on. He was optimistic, more optimistic than a lot of people that I've spoken to, which is great. But really, really appreciate him coming on. And these are the type of interviews we're going to have going forward. I mean, this podcast is growing. It's getting bigger thanks to you guys. Getting more subscribers than ever. Twitter followers, everything. Curzio, YouTube, well over 1,200 now. I think it was 600. I think a month or two months ago. So thank you for spreading the word. And we want to continue to stay on this and just provide really, really great interviews for you. So I'm glad Mooch came on. Let me know what you thought of that interview. FrankCurzioResearch.com. That's Frank at CurzioResearch.com. And again, when you let me know what you thought about an interview, put politics aside. Okay, I don't care if you hate him, you like him, Trump supporter, not Trump supporter. I know he's CNN. He's on CNN all the time. Just let me know what you thought about his plan, his numbers, and stuff like that. Again, we don't want to argue politics right now. We're gonna have plenty of time to do that in a couple months. Anyway, when you guys listen to me in this podcast, right, and even when you go to the Curzio Research YouTube page, I do live daily videos every day, pretty much for 3-4 weeks now, I think. And they can all be found there. Some of them I have on Twitter as well. But, I'm offering my opinions, right? It's in my opinion. But these opinions aren't just, hey, random feelings and gut checks, whatever. They're calculated. They're based on tons of research and what I'm hearing from my contacts, what I'm hearing from you. And, I want to share all of that. So here are some of the things I'm hearing. And I talked a little bit about this before, but it's important. Italy, more than 80% of the people who died from the coronavirus, they passed away in their own homes. So they couldn't go to ICUs. That's what I'm hearing. Workers in the oil, airline, retail, restaurant industries, the layoffs have just started. It's going to get a lot worse. Remember, nobody's traveling, which means hotel industry, airlines, casinos still shut down or basically shut down when it comes to hotels. It's going to be that way well into April. A lot of these companies have debt payments to make. Hopefully, it's going to be backstopped by the government. But how do you pay your employees when you're leveraged and you're not generating revenue? I don't know. Answer that question for me. I don't know the answer. It could happen for a little bit, but eventually you got to dwindle. And now look at where your financials are going to be when we come out of this. You think these guys are going to spend and go crazy? First of all, it's not going to go back to the same levels when it comes to the airline industry. Not going to come back to the same levels. The casino industry, hotel industry, airlines, all that. So now you basically depleted your reserves, tapped credit revolvers. Okay, again, you're still looking to get back with the airlines. I mean, look how long they went through that period of being in so much debt and then coming out of it and the massive cash flow that they were generating. It was perfect for them. And now look what happened now. And the cost to manage these companies, fuel, flying, just unbelievable. And they were making a fortune, but when you turn off the revenue, no one's flying anymore. You're not generating money. Another thing I'm hearing from good friend, bond fund manager, saying how liquidity is not really the problem right now, which I was surprised to hear. It's much more than that as firms are going into cash. Why? This is really important here, guys. Okay, very, very important for you to understand. You're going to go back to the credit crisis. Okay, because if you could invest during a credit crisis before it happened, if you can invest in something safe as a firm, and you have a safe investment, you want to leverage yourself as much as you can. As much as you can, right? This is what happened in the credit crisis. We found a way to package subprime debt into huge debt vehicles. They were called mortgage-backed securities, MBS, and also collateralized debt obligations, which are CDOs. These are forms of securitization. Okay, so it's when we had loans, good loans, prime loans, it was fine. Everything was cool. Then we went to subprime loans. Now, once we had these MBSs, CDOs, Wall Street paid the rating agencies to stamp AAA ratings on this, which means what? It meant that Wall Street can now leverage the F, I won't curse here, out of these investments to generate even more income. So this misconception out there where subprime loans were the cause of the credit crisis. It wasn't. It was just a $1.3 trillion market. We just passed a $2 trillion package just today. It was a massive, massive leveraging of these loans. Synthesized. It was collateral debt obligations. It was times 10, times 20, times 30. And the leverage on this was incredible, where we only needed to see a 5% decline in default rates or default rates, and that was it. This market was going to crash because everybody had to go to cash. They didn't have the money. It's like getting a margin call. It was a massive leveraging of these subprime loans that caused a crash because the collateral was deemed to be safe. And we all know what happened, right? We all know what happened with the market. Wasn't as safe. These vehicles weren't as safe as everybody thought, and it wound up causing the credit crisis. Why am I revisiting this? Why is this so important? Stay with me here. There's another market that few people are talking about. It's pretty scary right now. This is from my close contact, Von Industry told me. Collateralized loan obligations, CLOs. They're another form of securitization where payments from basically multiple mid-sized large business loans are pooled together. Sounds familiar. And they're passed on to different classes of owners in various tranches, right? Sound familiar. Now, CLOs are different because most contain corporate loans that have low credit ratings. Keep that in mind. Low credit ratings, not investment grade ratings where the government's investing. Low credit ratings. They pull these together to make them safer. If you want an example, it's like, leverage buyouts made by private equity firms, which are huge. Those are not investment grade, where First Data with KKR. I mean, there's so many examples where they take out enormous amounts of debt, and these things have lower credit ratings, and they're packaged together again in CLOs and then sold to investors saying, hey, these things are kind of safe. This is a huge, huge, huge market that's super highly leveraged. And what do you think firms are doing right now? They're deleveraging. This is causing the system to freeze. They're going into cash. Why? Because all of the credit ratings on these companies, which are already low, right, already risky, if they haven't been downgraded, they're going to be downgraded significantly over the next few months. There's no revenue coming in. And you look at Fitch, credit agency just came out, downgraded like 80 companies. This included Ford's credit rating, putting their investment grade status in question. Also cut airlines. They downgraded Disney's credit from stable to negative. And Disney, 4 days ago, just raised an emergency $6 billion. That was on Monday. Nobody talked about that. Disney raising money? Yeah, they had to raise money. $6 billion, pretty high interest rate. I think 4 or 5%. But they closed that out on Monday. But now you're seeing all these get downgraded, which is going to make these investment vehicles, in trouble. And this is a problem a few people are talking about right now. This is major. It's a huge market. When everything's supposed to be safe, it's been safe, especially since the credit crisis and even pre-credit crisis. Have investment grade ratings on these loans. They're risky loans, but you don't see them default. Now look, all the downgrades. You shut off the economy, you shut off the revenue, you shut off everything, practically everything. Nobody's talking about this. These are things you have to worry about if you think about jumping in the market with both feet here. So lots of risk out there. It doesn't mean, again, I'm not working my ass off. I'm doing more work than I've ever done. Everyone listening to this should still have most of their money in cash, looking to pick away. For me, things I'm looking at, large cap names, especially retailers with stores that are open right now, that provide necessities. Not many of them. But these are companies that are going to generate a shitload of sales. They're going to report strong earnings easily over the next 12, 18 months. And that's a certainty. They can model. We could see that. These are companies I could look at and say, wow, these guys are going to generate X amount. And these companies have held up well. Some have even up during this whole month, whatever, downturn. But the sales and earnings these companies are going to generate are incredible over the next 12, 18, 24 months. That's going to continue. And again, you could see it. You could model for it. You see business getting better and better. They're hiring more employees. That's the certainty here. That's what I like to see. Medical device companies going to be operating at full capacity for years. Masks, ventilators. Becton Dickinson, you have Medtronics, and lots of these companies. Again, this is just starting in other places of the world where, these ventilators are not just going to be for here, but this is a problem that's going to last for a while. And then they're going to be stocking up on this too, once just in case we run into a problem like this again. That's what we do. Gold stocks. I mean, again, it's a tough market that's whipping around like crazy, but I have to tell you, I'm looking at gold companies, and a lot of gold companies with their financials, they use a base price. So they were using $1,000, $1,100. Most are using $1,250, and now we're $1,600 an ounce. And some of these companies are now updating these estimates and saying, well, here's our IRR, here's how much we're going to generate if it's a junior miner company. And it's a good project that's going to get developed maybe 10 years from now. And the costs were $1,100, $1,200. And you're like, I don't know. That's kind of close. Maybe that company's worthless. Now it's $1,600. No longer worthless. And they're updating these estimates. And when they're putting them out, you're seeing a lot of these stocks go higher, where a lot of them were modeling for $1,250 an ounce. Not saying that we'll say it's $1,600. I think we're going to go much higher. I'm just not too sure why that hasn't happened yet. Maybe it happens over the next year. Maybe that, again, I'm picking away. I would say about 8% of my holdings are in gold stocks or gold vehicles and things like that. And I haven't sold anything yet. But I'm in for the long term, and I think it's going to be good long term. Short term, you're going to see a lot of volatility here. Risk on, risk off. But you're going to see majors start investing in the miners, not necessarily taking them over, but investing in a lot of these names at much cheaper prices over the next 3 months, probably. So there's a lot of hidden gems out there that got smoked that I'm looking at. Specifically, looking at ones that do not need to raise cash, have high-grade assets with low production costs, or that's what they're forecasting, and ones that have strong management teams with high insider ownership. That's what I'm looking for. And there's about 4 or 5 of them come across. And you're going to see them probably in CVO within the next few weeks. My Curzio Venture Opportunity newsletter. Not all gold stocks are the same, guys. There's some that have gone down just as much as the garbage. And I've seen this market. I mean, when you have a bull market in gold, these things don't go up 200, 300%. They go up 5x, 10x, 20x. And it's been a horrible market for a long time, outside a few pockets here and there. But with every central government throwing everything at this, trillions of dollars going at, and more is going to be announced, I'm telling you, over the next 3 weeks. They're not done. It's the only catalyst for the markets. It's the only catalyst. There's nothing that's going to be positive other than if the Saudis and Russia come to a deal with oil and push oil prices higher, maybe. But we're going to see explosion in cases, all this negative news. So you're going to see that governments go on and continue to print money like crazy. I'm looking at small caps. A lot of them are still down 50% plus. Dangerous market. But some of these names, their cash positions are now more than 50% of their total market cap, which is insane. So I'm finding ideas right now. Not tons, but some. Just being very careful. So my Curzio Venture Opportunities newsletter, you're going to see a video update newsletter, just like we did with Curzio Research Advisory, which is mostly mid caps and large caps. It's focused on small caps. Going to put that out tomorrow. A lot of research for you right now. And the reason why I'm doing video updates is because, I was writing 19-page reports, but, look how much changed. I mean, in the last 4 trading days, we saw an unlimited package by the government, right, saying that we're going to invest in investment grade bonds. We've seen a $2 trillion package on the fiscal side from our politicians. We've seen the market decline by 5% and 6% back-to-back days, and then increase 11%. So you can't write these reports that take a long time, 2 to 3 days sometimes, to write when so much is changing. So now we're doing video and getting a lot of positive responses for that. But anyway, in the CVO newsletter, you're going to see a video update tomorrow. I'm going to provide screens of stocks I'm looking at because, again, a lot of really good names worth picking at. And they're going to offer 3 to 5x upside. And I'm not talking about long term. I'm talking about the next 2-3 years. Probably being conservative on these projections. So it's going to be an incredible buying opportunity, maybe bigger than 2009, but you still have to be patient. The companies you're investing in, it can't be a guess. They need to have a little bit of certainty, at least when it comes to sales, potential earnings, their business model, what they're doing here. So I'm starting to come across a lot of names like that, especially the small cap sector. So again, if you're a CVO subscriber, expect several of these names to make their way in the portfolio over the next few weeks. And putting this all together, look, we could see more pain ahead. It's likely. Too much uncertainty. But for me, I'm starting to pick away at names that have strong balance sheets, that do not have tons of exposure to coronavirus, which is not easy to find. Almost every company has at least a little exposure, especially if you're leveraged, right? Every company that's leveraged has exposure. But just focusing on companies that could actually give us some sort of forecast of what they believe sales earnings should be in 2020, 2021. And that's what Nike did today. And look at where that stock really took off. They did it last night. It just gave you a forecast. I don't really believe it too much, but at least they're saying our stores are open. Here's what we're seeing. That's what people want to see. They just want to have some kind of certainty. And when we have that, that's when it's going to be the time to jump in. Don't worry about missing a 4 or 5% move here or there. These things are still down tremendously, a lot of these names. You just want to be smart here. You don't want to buy and be down 20, 30, 40% and just you got run over by a truck. Because being on a cash or being on sidelines is going to be worthless if you just threw all your money into the market maybe 2 weeks ago, 3 weeks ago, 2 weeks ago, and you're down, another 15%. A lot of names that look good. You see them coming out in my newsletters. Just be very, very careful. A lot of people asking me, how's the best way to play this? We came out with something for all the subscribers. And a lot of people on our list where we offer a deal for our newsletter, Money Flow Trader, which is an incredible product right now. It's how to use option strategies to bet against individual names. It's not, very few positions. Ginny Terranova, amazing analyst, goes few of them. She'll go short. Most of it is just options. So you're only going to lose the money that you put in. But the gains that she's booked, and this is going to continue. I know you've seen the market go up right now the past couple of days, but you're going to see whipsaws back and forth. I mean, Starbucks booking a 500% gain in Starbucks. Teva, 140%. Bed Bath & Beyond just sold a 150% gain. Shake Shack was up 70% in a few days for her. I mean, just the gains that you're seeing in that newsletter and someone from that experience, again, I'm honored that she's working for us. But that I lowered the price for that newsletter for everybody. I cut it in half. If you're interested, that's one way. That's what I'm doing with my money as well. So if you guys are interested, when not offering that price to anyone outside of our list, it's just our list, and we're going to sell it probably for 3 or 4 times the amount that we're selling it for now, because that's how good that newsletter is, and it's going to be relevant for a very long time, at least for the next few years, because there's going to be a lot of uncertainty out there. It's going to give you a great chance to pick off some of these names that are going to bounce back tremendously and then probably go down a lot more. Not everyone's immune. Some companies are going to see long-term effects to this. Movie theaters, airlines, travel industry, where a lot of restaurants can come back online. They might see revenue a lot quicker. But it's pretty crazy out there. So, guys, if you're not a subscriber at all to any of our newsletters, you want to learn more about the coronavirus and, want to learn more about us, just go to our website, CurzioResearch.com. I still have free reports on there, even older ones, so you can see exactly what we're saying since early February before the market crashed. And these are absolutely free. Also, if you're looking to try out our newsletters and give it a test ride, Curzio Research Advisory, this is a couple of days ago. I ran a bunch of screens of stocks that should be on your watch list. I included about 100 of them. And these screens included ones with strong balance sheets, early cycle names, rebound once, we do hit a bottom. names that perform the best during inflationary times, deflationary times, and also names that are likely to cut their dividend. So I ran those screens, sent them to my subscribers. That newsletter is $50, not a month, but for the entire year. Again, I'm not going to keep it that price long, but I really want people to get exposure to this. Just the information I'm hearing out there, it's dangerous. There's a lot of guessing out there. Yeah, it's just for me, I'd love for people to provide a low price. Again, it's $50. It's not going to make me a billionaire or anything, but that's a newsletter, kind of like a star newsletter, large caps and mid caps that you could take a look at. And we've done very well over the past few years since we started that. So I'm really proud of that newsletter. But again, we lowered that price for everybody. If you're interested, you can just go to our website to subscribe. That's CurzioResearch.com. And I say this a lot, but this is absolutely for free. A Curzio Research YouTube page, doing live videos, doing a lot of podcast interviews. Getting a lot of page views, even at conferences, those are taped. I throw all that on our YouTube page so you guys could see it. And if you subscribe, it automatically alerts you. So, we're getting a lot of traction there too. And I really love doing these videos and updating everybody. So that, and even on my Twitter account at Frank Curzio is where you can get, a lot more updates and not just a weekly podcast. So, man, covered a lot today. Just stay safe, guys. Be patient. Have fun with your families. I know it's not the easiest thing being at home. The interviews that I've done over the past couple of weeks, they had the kids running around and stuff like that. It's a crazy world right now, and I get it. But I still think there's a lot more risk out there. Just be a little bit more patient, and you'll see me start picking away in my newsletters over the next few weeks. So that's it for me. Thanks so much for listening. Really appreciate all the support, all the emails coming in at frankcurzioresearch.com. And I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.